Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Today we're marking the 5-year anniversary of Fidelity Long Short Alternative Fund. Over that 5-year period, markets have thrown just about everything at investors. Global pandemic, and with it its extreme volatility of 2020, the speculative surge of 2021, the rate-driven reset of 2022, political change here at home and in the US, around the world, and a fresh wave of momentum, certainly powered by AI enthusiasm. So before we dive into what's happening now, we're going to rewind just a little and look at how the fund has navigated those very different market environments. What has our next guest learned along the way, and how has it helped frame his strategy position for tomorrow? Joining us here to unpack all of this and more is Fidelity Long Short Alternative Fund Portfolio Manager, David Way. Warm welcome to you, David Way.
Thanks for having me.
Being here. I'll remind everyone that this is available with live French audio interpretation, so join us in either official language. Can you please let us know how this all began? Fidelity was very good, actually, at finding the losers and avoiding them for a long, long time, a track record of it. Now suddenly you're using those. Just remind us how this came about.
So I started at Fidelity like almost 20 years ago. It was the summer of 2007. And so over my career as an analyst, it was my job to do what all of our analysts do, which is identify the companies that are going to outperform and make sure they end up in our portfolios, and also identify the companies that are unlikely to outperform and avoid them. And one of the things that emerged from my analyst tenure was kind of a special interest in separating those companies that we should avoid and actually grouping them into, what are just sort of middling average stocks, like not terrible, but not as good as the winners that we can find. And then finding the companies where real problems were about to emerge and where we would see more material underperformance. And fast forward to 2018 and talking with Andrew Marchese, our CIO, about opportunities to try to use that skill and sort of demonstrated success that I had over my analyst tenure, and really coming together with a long short alternative fund where we could do what we do on the long side, get excited about opportunities, find the winners and capitalize on those, but also, both enhance returns and reduce risk by taking advantage of that pool of underperformance and using shorting as a mechanism to find additional uncorrelated or less correlated sources of returns. And so that really came into the fund's objective of saying, hey, there's an opportunity to take advantage of what we do to have a different return stream and lower risk. And when I started the fund, that was my objective. And I'm kind of sitting here 5 years later, hoping to continue to kind of do the same.
Well, it's incredible. And there have been some stark moments where you've been able to sort of hold onto the handlebars and ride up and down some of these jagged market moves that have happened over the course of the lifetime of this fund. Are we in another one of those moments right now?
I think the only constant in the market is change. And
it's a good answer.
If you look at a market chart over 100 years, it kind of looks like a pretty smooth ride. And the reality is there's volatility. And it's really important that when the market is rising, to capitalize on that, to capture returns. But I would also say that it's equally or even more important to protect capital during the periods where we do see that downside volatility. And when it happens, it can be big, and it's important to stick to a long-term process, protect capital, and be ready for the other side.
But you don't want to be too early calling a market downturn. That's sort of where we're sitting right now. And I want to go back into history to sort of get us here. But we are apparently grappling with whether it's too early to call a market top, aren't we?
Yeah, I think in some ways it's a fool's errand to sort of say this is the top, this is the bottom. And the market is a big place with lots of different things going on, different sectors, with different types of cycles going on. And so before we launched the fund publicly, I was running a pilot version of the fund.
This is in COVID?
It was 2018 through 2020.
Okay.
And as we got to the end of 2019, one of the things that I started to see emerge was some overheating in parts of the consumer environment, some overheating in the financial sector where credit risk was growing. And so I didn't know that COVID would be the catalyst for those shorts playing out. But ultimately, when things are just like really good, sometimes bad things happen. And so what I try to do is look at the market on a bottom-up basis, the top down tells me like, what's the weather? What should I wear outside? But you go outside and you look for ideas and try to do bottom up stock picking and look for stocks that might be priced for perfection, where there's things that could go wrong. And then you try to execute on the short portfolio, while at the same time being open to the fact that, whether, valuations are at concerning levels at a market level, or if, things seem too good, that there will always be idiosyncratic opportunities to find companies where things are getting better.
Well, and you're known for that. I mean, that's an area. So give us just sort of some broad examples of that time. So yes, as you say, COVID ended up being the catalyst of all catalysts for everything. But what did you do specifically in that moment, and then coming out the other side?
So in 2020, as COVID was happening, really it was, harvesting profits on the short portfolio. Like I had a number of stocks that were down 80, 90%. And then as we, approached a market bottom, it was, no one really hung a sign saying this is the bottom, you got to get in and buy it. But some things happened. I think one of the big catalysts for me really changing my positioning was, not just necessarily stocks getting really cheap, but the Federal Reserve coming out and saying, really, we'll take any kind of collateral. And some of the stocks that I've been short, experienced some, significant upside, which told me that, things were going to stabilize. And having lived through the 2008 downturn, the importance of credit and liquidity in the system, really is paramount to creating the conditions for a recovery. And then we sort of ran with that until, the end of 2021. And we got to the place where we'd had the meme stock bubble. Fortunately, the fund had navigated that by avoiding shorts that can double on you overnight. And, the opportunity to short sort of became ripe again and really lasted until the end of 2022, when sort of the current bull market started.
Okay, so let's go into sort of the 2022. This is where we've seen rates do what they're going to do. The concern is the massive monetary change, and also the run up of what we call the Mag 7 now, and then, of course, their demise initially. What were sort of the beginning signs of the marketplace in there that, again, are analogous to times like this?
So I think in 2021, we kind of got to the middle of the year where we saw conditions like we see now, where you have profitless companies that are leading the market. You have companies with no or very little revenue, enjoying market caps of, 10 to $20 billion. And, while there is probably widespread agreement that many of these stocks are speculative and unlikely to grow into their valuation, so they could be good shorts. If you were too early, you could have lost a lot of money shorting those stocks, because momentum at some point becomes a lot more important than valuation and underlying fundamentals. But then as we got into late 2021, it became clear that momentum was sort of breaking down. And I think part of my process is really respecting momentum when I'm looking at shorts and doing the work ahead of time, so that when the conditions are more ripe, you can really step in with conviction and short these stocks.
So that's interesting, because sometimes if you don't want to be too early, what that can mean is that you're actually in the stocks with momentum. Would you then turn to short them?
So typically what happens in the fund during periods like this is that there may be stocks that I own for fundamental reasons that then appreciate quite meaningfully and sort of on the long side, and then become momentum stocks. And it's possible that I'm still enthusiastic about the company, the fundamentals, the earnings growth, but I start to get worried about how far some of these stocks run. And one of the unique things that's available to me as a short seller is that I can actually identify companies that might be exposed to the same trends, and I can go out and I can short a less well-positioned company, and actually, even before I've fully sold a position that is currently generating profits for the fund, I can start to hedge out that risk. And it's just important for me in particular to be able to do that, just because of my temperament. Like at the end of the day, you have to.
Well, you have a style.
You have to manage. You have to manage a fund the way that you believe is right and really fits your investor psychology, and in my case, a preference for being able to underwrite companies, using valuation principles. And so it's part of why I wanted to start a fund like this, because it really matches how I think.
So take us through. So 2022. everything slid together. There go
Yeah.
the stocks and bonds,
Yeah.
which was very painful for a lot of people with 60-40 approaches to the market. As a result of that, or at least one of the results of that, seems to be that alts have a new place in a portfolio that could be on the 40 side. This is discussed greatly. Ultimately, what you offer is equity. So it is not fixed income at all. Tell us just a little bit about how portfolio allocation and construction has changed. It doesn't mean that you need to tell us how everyone should construct their portfolio, but what are you noticing as changes?
Well, I think when people started to adopt this fund in their client portfolios, the initial piece was looking at taking from the equity allocation. And in the end, this fund does have equity exposure. I have 100% of my money invested in this fund because I believe in equity markets long term, and I think it's an attractive place to invest. But where the lines start to get a little bit blurred is if you look at the downside protection of the fund. If you look at moving from, as we did in 2022, from a zero interest rate period to a something interest rate period, financial conditions are relatively easy today. We have fiscal deficits. We've got monetary policy that is easing.
There's money sloshing around out there.
We have tight credit spreads. It's very easy for a lot of companies to raise money. If we see those monetary conditions tighten, and that could be something that we do see in 2026, we could see a similar environment to what we've seen in 2022. Now, we might not. But as an investor, you have to position your fund for, not only the things that can go right, but the things that can go wrong. And if that were to be the case, I want to make sure that the fund is positioned to protect capital as it did in 2022.
So let's dive into the question of AI, where it belongs. The discussion, you can't get too far without talking about this. It's very important. For instance, software, traditional software, to a certain extent, there's been some leapfrogging there because you can just do it with AI instead. How do you look at certain areas of the market like that? Do you make big calls? Do you just wait?
I think on the software side, AI is a very big theme. I think that's the starting point. I think
don't get in the way.
Over the next 10 years, it is very likely to be part of the one or two or three things that materially shape how we live our lives, how we work, and how we interact with other people and information. And so when you have a major theme like that, the world is going to change a lot. It's going to create new winners. It's going to create some losers out of existing incumbents who fail to adapt. But it does create a window for people to use technology in their business. And I think one of the mistakes people make is that they're like, okay, this new AI company is going to do this new thing, and nobody else is going to change how they do their business. And in strategy, it's always important to understand the initial action and then what the reaction is going to be.
And that your competitors are all working on fitting
everybody's doing it. Yeah. And so what you have to think about are the companies that are endowed with the right positioning. And so, NVIDIA was a graphics gaming company, and they just happen to be in the business that has become very important. So the company has executed well. They've managed to stay ahead of their competitors, but they are very well positioned to benefit from growing AI spend in the US, but in particular, the rest of the world where growth has materially lagged.
So let me just ask you on that. You have the ability to go outside of North America if you choose. Is there, while we're on the topic of AI, interesting opportunities for AI around the world? Lots of countries have to catch up, ultimately build their own.
I mean, there's a lot more companies involved in AI infrastructure than NVIDIA. And so, what I've tried to do is at various points in time, I have found enthusiasm for, a stock like NVIDIA to be, high, perhaps too high. So I owned the stock in 2023, sold it in 2024. And then, fortunately in the downturn we saw in April, the company, the stock fell almost in half. And so it was a chance to revisit a company that I sold that I was, optimistic about, but I thought had got too expensive. And similarly, there are other global players with, really excellent and hard to disrupt franchises that are involved in AI infrastructure. And even within, the Mag 7, like I don't really feel a need to own, the Mag 7. I generally believe that over time we should see, more opportunities to be different than the market outside the very largest companies. But the reality is over the last few years, the biggest earnings growth have come from the biggest companies.
Right.
And so, it's my job to be flexible and, not hold to a hard and fast belief about where I need to invest. And so you can think of companies like Meta, Google, Amazon and Microsoft that are beneficiaries. And so from a fund perspective, I have tried to take advantage of those opportunities. And you can see, big changes in views because the technology is quite emergent. And earlier this year, a lot of people felt that, Google was the big loser.
Yes.
And
It
there was a
flipped.
material drawdown in the company. And it at the time, if you did the work on where AI was potentially going, sort of Google's fully integrated, sort of full stack approach, even though their search business was, at risk and something they needed to deal with, you could see that Google was very well positioned, and the stocks like doubled off the lows. So in big companies, there's still very divergent opinions, and it's important to invest with conviction and a lot of research behind your views.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
There's also discussion about how policy has driven investing over the course of the last year. Lots of U.S. policy, some of it reverberating obviously in countries around the world with tariff policies. I mean, when you watched Canada go through some of this, lots of other countries going through it as well. Again, do you take a look and say, gosh, this is an area where something can't be sustained, a particular sector is going to get hit with tariffs? Again, do you wade in there so that you can have conviction in other places?
I think if you look at the bigger sort of geopolitical events going on, it's clearly we're moving from more of a free trade environment to a more restricted trade environment, more tariffs in the US. And that has led to some uncertainty, some friction in terms of consumer spending. Tariffs, at some level are working their way through consumer wallets and constraining purchases. And you can look at any number of consumer companies that have reported this quarter, and they are seeing, just a more careful consumer. Although spending remains resilient, even within Canada, the consumer has been more resilient than I probably would have guessed 2 years ago if you had laid out this scenario.
Well, 2 years ago, we thought in Canada everyone would be really hit by the mortgage renewal wall.
Yeah.
And it's not to say people aren't suffering at all, but it doesn't seem to have had a contagion.
No, we've had, obviously the housing market is in a downturn. It's a very important part of the market, but we have avoided, thus far, the bigger, mortgage renewal gaps that, we were talking about.
And the reverberations ultimately.
Absolutely.
I wonder if you could, here, actually, let's put this question to you. This is a great question. So could you, David, talk about some protection strategies that are in place for the long-short fund? Just, the volatility, market movements. Yeah, how does that work?
So there's really two tools available to me to, protect capital ahead of if we do see any kind of market drawdown. So, first in terms of picking securities on the long side. So companies that might be less economically sensitive, or they may have some economic sensitivity, but some degree of self-help or improving cyclical backdrop. Like U.S. housing, for example, is in a multi-year deep recession. It is, arguably at a cyclical trough. We are at a record low in terms of the number of resale homes that have traded in the U.S. this year. I think it's 2.8% of existing homes were sold this year versus longer term, above 4%. So it's hard for things to get worse. And so even though we have, broader economic concerns, looking ahead to lower interest rates in the US, perhaps even quantitative easing to bring, longer term interest rates down to enable people.
Why do you say that? Perhaps even quantitative easing. I mean, is that circling as a possibility?
I would say that it is not a consensus opinion.
We cannot print more money.
Well, I think if you look at the U.S. economy, one important driver of growth would be a more resilient U.S. Housing market. It is a big part of the economy.
Right.
And
one the Treasury Secretary is very focused on.
Precisely. And so lowering interest rates, helps the financial markets, but people need more compelling 10 and 30-year mortgage rates in order to, feel more comfortable selling their house, which might have a 3% mortgage attached to it, and then moving into something that, maybe has a, 4% mortgage.
That is fascinating. So when you look at that and sort of the rumblings of that changing of the guard, perhaps, how do you enter that in terms of investing?
Well, I think one of the things, and it was similar to 2022, where even though I was, not as positive about the economy, there were a lot of companies pricing in sort of a full multi-year recession. And so you lean on valuation. So valuation protects your downside. We've seen a number of building product companies report this quarter. Numbers are terrible. Volumes are down double digits year over year. And the stock prices are quite resilient because we're at a bottom. Everybody knows that things are bad. And so what you try to do is you try to have some part of your portfolio that is exposed to these types of companies that are at a cyclical bottom, where there is lots of room for things to get better, even if the rest of the economy is a bit shakier. Like, AI has probably single-handedly kept the US out of recession. Like, statistically it has. And so, if we do see any kind of slowdown or at least slowing growth, there are other parts of the economy that have been effectively crowded out that we could see reemerge stronger.
Fascinating. When you look, again, just to sort of stick with this policy theme for a second, so one component of the big beautiful bill, so-called, has been obviously the tax cuts and taking a look at how depreciation could be entered in, but also this deregulation. Based on it, it looks like there could be a whole bunch of regional bank mergers, for instance, a consolidation. Is that something, a merger acquisition environment that you can enter as a long-short manager? Is it of interest to you or not really?
I mean, certainly the potential for consolidation in an industry is, it can be interesting. Yeah. In the case of regional banks, these are, businesses that, they're not as strong as money center banks. Like, their balance sheets are less resilient than, a JP Morgan or Wells Fargo might be. But there is, clearly a consolidation story. And I think the rise of AI and, technology as a backbone to, kind of any business is going to, increase the minimum efficient scale of operations. And so I think technology and regulation will create more consolidation in regional banks. We've got a great bank analyst who's always trying to find ideas for us. But it does become kind of one part of the thesis. Okay. And even within industrial sectors where, perhaps you have multiple competitors in an industry that they might have struggled to consolidate, 3 or 4 years ago, that could potentially consolidate now. Those can become even more interesting because as you move from like 4 players to 3 players or 3 players to 2 players, you get the economic profit and sort of share of the profit pool that these companies can get can go up a lot. And so, that certainly fits into, our analytical approach to looking at these companies. Like, hey, if these 2 companies were to merge, like, how would that change the industry?
If I were to ask you a little bit about the performance of gold and also the relation of, we'll say Bitcoin particularly, because as Urian likes to mention, they play on the same team, different positions often, but are these of interest to you? Do you take part in, for instance, the gold rally or Bitcoin or any other crypto interests? Sure.
So I think with gold, it's not a natural asset class for me to own because I generally prefer productive assets that generate cash flow. Right. But gold does play an important role in a portfolio because to the extent we do see inflation coming from interest rates falling, fiscal spending remaining high, really globally. As well as geopolitical uncertainty. So we first saw gold emerge as an asset class that was appreciating in the aftermath of Russia's invasion of Ukraine. And, the seizure of Russian assets really led, many actors to decide that rather than hold US treasuries, they preferred gold because they were worried about their ownership of US assets long-term if geopolitical winds changed. And so we've seen meaningful central bank buying of gold, and that has been a big driver of the gold price rising. And now we have these other things emerging, potentially quantitative easing, lower interest rates, possibly inflation increasing, that would be a positive setup for gold, even from these elevated levels potentially. And so
is that a yes or a no? It's of
well,
interest to you?
the fund does have more meaningful gold exposure than it had even 2 years ago, and it is a downside protection thesis where if some of these risks don't emerge, then there's other parts of the portfolio that I expect to perform well. And if these risks do emerge, like there are some aspects of the fund that may require some hedging, and so gold is a very useful tool. And as someone who used to cover mining, I generally prefer multi-asset operators where you've got 5 or 6 different mines where you're not exposed to operational problems in any single asset,
Or they've got
or
copper
tax
and silver as
increases.
well or something?
Exactly.
Yeah.
And you can even look at the streaming companies or the commodity itself to protect, to get that exposure to the commodity without taking the operational risk.
So before I ask you to kind of wrap up with some final thoughts, we are discussing right now on budget day in Canada. So we don't actually know, there's been a lot of things announced. So there's some things that have been pre-announced. But ultimately, for your investing, for the economy, and ultimately how you would enter certain companies and markets and so on, what would you like out of the Canadian budget, or any comments on that?
I think the greatest economic challenge Canada faces today is productivity. It's something we've talked about before, which is that Canada's falling productivity is a headwind to durable growth. We've spent a lot more on housing than we have on building GDP enhancing and sort of skill and value add type assets. And I think some of the early messages we've seen from the government have been around trying to rein in government operating expenses and invest in productivity enhancing infrastructure. So I think that would be a welcome change from the past 10 years, as well as it could be opportunities for companies within the portfolio if we're spending more on infrastructure.
Do tell.
Well, you can think about like construction companies, equipment providers. Those companies may benefit from higher infrastructure spending. Those things all need forklifts and bulldozers and people working. And when those projects are completed, if they shorten commutes, harden infrastructure, you can think of myriad reasons how spending this versus just on sort of personnel expenses can lead to economic growth, incentivizing manufacturing, those types of things. It actually is probably a necessary and very timely type change in how we spend government money. I guess our money as taxpayers.
Yeah, and hopefully attract more investment ultimately one day.
Should be great.
So just to sort of wrap up for investors, the place, who is your fund for? I mean, I think it sounds like you treat it as core. Should many people think of it as core?
I think if you look at the experience of the fund over time, it has delivered strong returns. I would say compelling returns versus a lot of other equity funds and other alternative equity funds as well, with meaningfully lower volatility. And as someone, I've taken 100 finance classes through my undergrad and doing my MBA, but I think it's a very easy and important lesson that if you can add an asset to a portfolio that has high returns and low volatility, it is enhancing to your overall returns over time. Not to mention making the psychology of investing easier, of staying invested through periods of volatility, which I think is like the most important decision an investor needs to make. That when things are tough and you feel scared, it's important to stay the course. Like we all have longer term financial plans that are counting on you to stay invested through those periods where the best returns might be just around the corner. Right. And so I think this fund fits very well into an overall portfolio of helping to achieve that goal, which is so critical to the success of a financial plan over 10 or 20 years.
David Way, congrats, happy anniversary to your fund, to you, well done, and thanks for sharing your thoughts with us today.
Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.